Hey folks, Jeff Bangerter back with you talking about 1031 exchanges using the Delaware Statutory Trust. These are securitized, fractionalized properties where you own a fractional interest, a beneficial interest in the trust, and the trust takes care of all of the property needs for you. So I want you to just think about this. These are investment grade properties, very nice properties. They enjoy stable cash flow from rental income, which can be paid monthly and even quarterly in some cases, but typically you're getting monthly cash flow. I did mention in a previous video, we do have a company that does oil and gas mineral rights, and that is paid quarterly. It's a little more aggressive because you're going to see fluctuations based on the the price of oil and gas. So, but most of these are just buildings, and they pay consistent monthly rent that you can utilize. They typically will use what's called a master lease structure, which contractually obligates the sponsor company to pay you your rent. So they have to make sure that the building is full so they can pay you, right? Now, it's not, it's not a guarantee, it's not a bond or anything like that. So it does have potential to fluctuate. If we lose a tenant or something happens, it certainly can be affected. But I think when you really start looking at who the tenants are, or if you go with the multifamily or storage, those things where we have a lot of tenants. And so I want you to think about it also from a tax standpoint, right? So this is tax advantaged. You're deferring the capital gains tax and the depreciation recapture, but this is real estate, and you're going to get depreciation. And especially if you, let's say you are all in cash, you don't have any debt, but then you take on leverage, you do a DST that's say 50% leverage, you're doubling the amount of real estate that you own, so you're going to get more depreciation, and we're going to pass through all the depreciation and all the interest deductions. All of the deductions you normally get on your real estate, you still get. And we're just going to pass through all that information to you, and you can give it to your tax person, and they're going to take care of that. Or you're going to, if you're doing it yourself, then that's great too. We can help your tax person. If you're doing it yourself, I would recommend that you hire a tax person the first year, because a 1031 is a little bit complicated. You want to make sure that you don't mess it up, right? So anyway, the bottom line is the debt that we have on the property, again, is non-recourse, but you still get the interest write-off, right? So all of that stuff is really going to help drive the benefit of owning this securitized real estate for you. So I think that this is a great opportunity. A couple other things from a tax perspective that I think are unique. The 2017 Tax Cuts and Job Act did provide a 20% deduction for qualified business income, and most of the DST sponsor companies agree that you will qualify for it. Obviously, this is going to come down to your CPA and you, but it looks like you should be able to get a 20% deduction for that income as well. So highly tax advantaged. We think that it is one of the few things that you really can enjoy tax benefits with steady cash flow. So thanks for watching. If you have any questions, give us a call, 800-451-2351. Thanks for watching.